students. I'm Brenda, and I'll be taking you through topic 2, and we are learning about accounting for revenues and expenses. So in our accounting records, we use books, we use things like receipts, the bills and the invoices, the statements, whereby we use them for our accounting records. So we are going to learn about the source documents that we always get, and let me write it here. Accounting for revenues and expenses. Yeah, so we are going to write, we are going to learn about our source documents. The source documents. So these are the documents that we get in any transactions that we make. Let's say the likes of receipts, the bills, the statements, the checks, the invoices, all those are our source documents. So we have our receipts. So receipts are basically what we get after paying or after a cash transaction, when we buy things on cash. Then we have our bills. So we have bills of exchange, where we get them when making our transactions. Then we also have the statements. Statements are also the source documents. Statements. So here we have the bank statement or the bank reconciliation statement. It is one of our source documents. We also have checks. So these are our original source documents that we get, that we always use them in accounting for our revenues and expenses. And in the last class we talked about revenues, and we said revenues are sales that we make from our businesses. Then the expenses, they are the costs that we always make, the costs that we always incur in our sales or our payments. Then we also have some other documents. We call them the original documents or original day books that we use. So we have our original documents. So in our original documents, we have the books. We have the cash books. We have the cash books, the petty cash book, and the cash books, which we have the double cash books and the 3-column cash books. So those are our books of accounts which we have, and I will write them here. We have the cash book, then we have the petty cash book, so the cash book, basically we have the 3-column cash book and the double cash book, whereby double and the 3-column cash book. So here we have cash transactions and bank transactions in our double cash book. And the 3-column cash book, we have the bank and the cash account and the discount received, discount allowed. Also in our cash book, we have a petty cash book. Our petty cash book is used to record transactions or payments that we make or we incur in our business when which are short term. That means they cannot wait until the end of the year so that they be paid. Let's say examples like the bills, water bills, electricity bills. So those are our incurs that we get. So we put them in a petty cash book where it is used to record the small amounts of cash. Okay. Then we have original documents. We also have a sales day book. Sales day book. So our sales day book, we use it to record transactions that are made in cash or after a sale is made. So sales day book. We also have purchases day book. Purchases day book. Let's say we have made a purchase. Our suppliers have given us some commodities or some inventory. So we get purchases day book from them. We also have sales returns. Sales returns day book. Sales return day book where we record transactions made for sales that were returned to us. We sold some items, but they were returned to us, maybe because they were of low quality or the customer did not like them. So we get sales returns. So we record it in the sales returns day book. So we also have a general ledger. We have our general ledger here. And this ledger is is also our original document of recording transactions made in the business. Let's say our business has a general ledger. We have the trial balance. Yeah, the trial balance. Let's say our business has, let me give an example. We have let's say Kamau business. This is our ledger. We call it trial balance. Trial balance. Let's say for the year. For the year 2022. Yeah. So basically our general ledger will have the debit and the credit side. Debit and the credit side. So here we have a description. Let's say we have cash. Let's start with sales. We've made sales. Let's say like 2,000 or 2 million. Put the zeros that way. Then we have the bank. Cash. Bank, we say we have like 100. Then cash, we will have like 300. Then we have expenses. Let's say like water bills. We have them like 200. Electricity, 100. Postage, 100. Then we have sales returns. Let's say like 2000. Sales returns. 1800. Then we have our calculations. Let's calculate and see. So 2000 plus 200, 100, 100. We have 2000, 2400 here. And here we have 1900. Also, this one should be 2400. So they should be equal. So here let's add like, let's say we have carriage inwards of 300. So it should balance. So our trial balance should balance on both sides, both the revenues and the expenses. So they should balance. Okay, so we can check on this. Let's say sales returns will be 1700. So we said our trial balance should balance. They should balance on both sides, both the debit and the credit side. So basically, this is our general ledger, and the general ledger, which is our trial balance. Now we are going to the next subtopic, which is the double entry concept. Let me clear this. So the double entry concepts. Double entry concepts. So our double entry concept states that we should have two transactions affecting our day books or affecting our source documents. That is the debit and the credit side. So let's say we have the debit and the credit side. Let's say we have a receipt. We have a receipt of our business, and it has receipts. So our customers came and they paid us from the bank. So our receipts will our sales will increase because of the receipts, and so our receipts we will credit our receipts because they are increasing. So increasing of the revenues, we credit. Any increase of the sales, we always credit. When what if it decreases? We will debit. So for now, our customers paid us through the bank, and they paid us, let's say, 2 million. 2 million, yeah, they paid us 2 million through the bank. So our receipts will decrease. Okay, our receipts will decrease. So let's close the account. Mm, 2000. Remember, they should always be equal. 2000, then our balance carried down will be 2000. So here we've made our receipts account, and we've credited the receipts account through the bank, and yes, through the bank. So our receipts will increase with 2000. What about the bank? Let's create the bank account. Bank account. So we have the debit and the credit side, and our bank will increase because it is cash that we've received from the customers. So we will debit the bank because of the receipts. Let's say the sales, or the receipts of sales, they increased by 2000. So 2000. So on our credit side, we will have the balance carried down, which is 2000. So this is our two accounts, and this is our double entry. That means every sale we make, it will affect our sales account and also the transaction of the cash or bank that we received from. So the double entry will be seen here on our two transactions, on our two books. So this is basically the concept of double entry, and we will make more practice on these questions. So we also have accounts, the personal and the impersonal accounts in this concept of double entry. So I will write them here. We have two accounts in the double entry, and the two accounts are the impersonal accounts, impersonal accounts, and we have two in this. Then we have the personal account, and here in our impersonal accounts, we have real accounts, and the nominal accounts. And here we have the personal account. They are just two, but the impersonal account is divided into two, the real accounts and the nominal account. So in our impersonal accounts, we have the nominal accounts. This means that this nominal accounts is intangible. The intangible items, the intangible commodities that we use in our business. They can be logos, patents, goodwill, all those. They are our intangible. They are intangible in nature. Intangible in nature. Then we have our real accounts. Our real accounts contain items that we use in our business. They are the touchable items, which we can touch. The likes of furniture, computers, motor vehicles, all those. These are touchable. Commodities. So these are our real accounts and the nominal accounts. So we also have our impersonal accounts. The impersonal accounts are two, the real and the nominal accounts. We also have personal accounts. Personal means it has a name. It has a name. That is maybe the business name. Maybe it's a sole trader or a company. It has a name. So this can be personal. It has personal names. So we can, so in our personal accounts, we have personal names. We can have Kamau, businessman. Kamau, businessman, sole proprietor. So this business has a name, but this name is personal. So that's what we mean by personal account. So learners, we've come to the end of our topic, and I hope you've learned something. Thank you for attending, and enjoy the rest of your day. Thank you.